Welcome to the deep dive. Today, we're going beyond the headlines on eMudhra Ltd. We're really digging into their strategy.
Yeah, we've got the financials, the press release, the conference call transcript for Q2 and H1 ending September 30th, 2025.
And it's all about digital trust, security, paperless solutions. So a lot to unpack there.
Exactly. Our mission today is really to understand how they're pulling off this global expansion. They talk a lot about enabling the enterprise transition to zero trust.
Right.
So we need to look at, what's really driving that 22.6% growth they reported. It's not just organic, spoiler alert.
Acquisitions are involved.
Big time, especially in Europe and the US. We need to figure out the impact of those, the costs, the integration challenges, and how they're navigating, well, some pretty tricky regulatory environments, particularly overseas.
Okay, let's get into it. The Q2 scoreboard first, ended September 30th. The top line looks, well, pretty impressive.
It does. Total income came in at 1,749.5 million rupees.
Which is that 22.6% growth year over year you mentioned.
Yep. And if you look at the first half of the year, H1 FY26, it's even faster. 3,255.7 million rupees. That's 37% growth year over year.
Wow. Okay, that definitely signals high growth. But, growth like that, especially with acquisitions, usually comes with questions about profitability and focus.
Absolutely. And that takes us straight to the margins. That's where you see the real story, especially when a company's buying others and expanding fast. Investors watch this like hawks.
So what are the numbers?
Okay, Q2 EBITDA was 433.3 million rupees. That gives them a margin of 24.8%.
Still pretty healthy.
It is. And growing too, 28.1% YOY growth on EBITDA. Then you get to PAT, the net profit. That was 264.4 million rupees, so a 15.1% margin. Still growing, but a bit slower at 18.6% YOY.
But wait, the source materials, especially the call transcript, spent a lot of time on adjusted figures.
Yeah.
Why the adjustment? Are they trying to, smooth things over?
That's always the question with adjustments, isn't it? But in this case, it seems pretty legitimate. They're pulling out some significant, but arguably one-off or non-operational costs.
Like what?
There was a partner stock buyback thing, about 27.7 million rupees, and then some ESOP charges and notional interest expenses. Stuff related to structuring deals and compensation, not core operations.
Okay, so if you pull those out.
Right. The adjusted EBITDA margin actually bumps up to 26.1%. And the adjusted PEAT margin hits 16.4%.
So the underlying business profitability is actually a bit stronger than the headline numbers suggest.
Exactly. And here's the kicker and why this adjustment matters strategically. That reported PEAT, the 15.1% one, it already includes a loss from their newly acquired European company, Cryptos.
Okay. How much of a loss?
About 15.6 million rupees in Q2 from Cryptos alone.
So they absorbed that loss and still managed double-digit PEAT margins.
Precisely. It suggests their core existing business is quite mature and profitable. It's strong enough to actually fund this expansion, even with a temporary drag from a new acquisition. That's a sign of resilience.
That's a really important point, and it leads perfectly into that whole strategic expansion piece. That 22.6% revenue growth wasn't just selling more stuff organically.
Not at all. It was a mix. Strong client wins, yeah. Particularly, they highlighted the U.S., Middle East, India, APAC. But also, a big chunk came from Cryptos in Europe joining the party.
And the geographic shift is stark. Enterprise revenue, 64% international now, only 36% India.
Right.
That's a huge change.
It really is. They're not just an Indian company with international sales anymore. They're actively becoming a global player. And acquisitions are like their main tool for that push.
So let's look at those acquisitions. Cryptos first.
Okay, Cryptos. Based in Europe, the deal was effective July 1st, 2025, so Q2 was its first full quarter contributing. Added about 220 million rupees to the revenue line.
And it's loss-making initially, as you said.
Yeah, integration is ongoing. Management said on the call they expect it to turn profitable in the next couple of quarters. Getting Cryptos' specialized services integrated and profitable is key for their European ambitions.
Then there's the U.S. acquisition, AI Cyberforge Inc. That sounds more like a technology buy.
Correct. AI Cyberforge brought in tech for key and secrets management. Think managing encryption keys, passwords, the stuff that underpins secure systems. It fits right into their existing cybersecurity suite.
Makes their offering more complete for enterprise clients.
Exactly. Helps them tell that comprehensive zero-trust story. And they expect to finish integrating that tech pretty soon, this quarter, Q3.
Speaking of the U.S., the transcripts flag something important. They finally got Web Trust accreditation for their U.S. data centers, New Jersey and Salt Lake City. Why was that such a big deal?
Oh, it was huge. Basically, without that accreditation, they couldn't issue trusted digital certificates directly from U.S. soil.
Which is kind of essential if you want to sell certificate products in the U.S.
It's table stakes, really. It was a major bottleneck holding back their U.S. product sales push. Getting that sorted, I mean, it sounds bureaucratic, but strategically it unlocks a lot.
And shows commitment. They even renamed their U.S. marketing arm to Certain X Inc., right? And hired senior local people.
Yeah, they mentioned a Scott and a Spencer specifically. Local leadership tasked with landing those bigger, multi-million-dollar deals they say are in the pipeline. It signals they're serious about planting a flag in North America.
But it's not all smooth sailing in the U.S., is it? The
Mm.
services side seems to be facing headwinds.
That's right. The conference call was pretty candid about that. Their U.S. services revenue, which is actually about two-thirds of their U.S. income stream, has kind of stalled.
Right.
It seems to be mostly external factors, uncertainty around H-1B visa rules, the difficulty, the cost of bringing in non-local talent. It's a direct hit from regulatory and policy shifts.
So how are they dealing with that? Just accept stagnation?
No, they're pivoting. Operationally, they have to. They're shifting focus to hiring U.S. citizens or green card holders for those service roles.
But surely that costs more. Significantly more sometimes.
It absolutely does. They acknowledge that directly. But their argument is twofold. One, they believe they can pass those higher costs on to customers, especially for sensitive projects where clients might actually prefer local hires anyway.
Okay, demand for local expertise.
Right. And two, they're actively trying to de-risk by diversifying their services footprint, pushing harder into the Middle East, APAC, even South America, so they're less reliant on the U.S. for service growth. But yeah, the U.S. cost base for services has fundamentally shifted upwards.
Okay, so geography covered. Let's pivot to what they're actually selling, the product mix.
Right. The split is clear. Cybersecurity is the bigger piece, 62% of revenue. Paperless solutions make up the other 38%.
And within cybersecurity, what are the stars?
The big names they push are SecurePass and CertNext. These are tools for managing identity, who is accessing what, is the device secure. Think identity and access management, IAM, certificate lifecycle management, CLM. It's all about providing that unified view of users and devices.
Which underpins that zero trust framework they keep talking about.
Exactly. If you're going to trust nothing by default, you need really good tools to constantly verify identities and manage the credentials, the certificates for both humans and machines. That's what their CLM platform does. That's the core value proposition globally.
And on the paperless side, mSigner is the main product. Is it just basic e-signatures?
No, it's more sophisticated than that. They really emphasize its strength in complex multi-party workflows. Think about opening a bank account or a complex legal agreement with multiple signers and required steps. mSigner manages that whole regulated process.
Especially in industries like banking, financial services.
Precisely. Where compliance and audit trails for signing processes are critical, that workflow complexity is where they differentiate.
Okay, so products sound capable, but capabilities only matter if they translate to sales. Any standout wins mentioned?
Yeah, they give some good examples. In the government sector, for instance, they deployed their MCA, that's their Certificate Authority Platform for a government project in Malaysia.
Okay.
They rolled out their CLM solution for a government authority over in the UAE and landed an e-signature workflow deal with a state government organization back in India. These are solid foundational projects.
And are we seeing the acquisitions pay off in terms of cross-selling or integrated deals yet?
We are, actually. There was a great example. A major contract with a large German retail and tourism company.
Right.
And the deal covered a whole suite, setting up their corporate trust center, managing their PKI, their certificate lifecycle management, and it specifically included professional services delivered by the team from Cryptas, the company they just bought.
So bundling the parent company's products with the new local expertise.
Exactly. That's the synergy they need to demonstrate to justify the acquisition costs. That win does exactly that.
Good example. Now, looking ahead, what about R&D? Where are they placing their bets for the future?
They're investing pretty heavily, it seems. Key areas flagged were inverged identity, basically unifying all kinds of digital IDs, human-machine application into one manageable system.
Makes sense.
Data privacy stack tools to help companies manage privacy regulations. Generative AI is also on the list.
AI, how are they using that?
For things like improving risk scoring, making sense of documents, automatically document intelligence, they called it, and crucially, post-quantum cryptography, PQC.
Right, the next generation of encryption to defend against quantum computers.
Exactly. And interestingly, they noted that PQC support is already available in their platforms, and customers are starting to ask for it in requests for proposals, even if wide deployment isn't happening yet.
So they're building in future-proofing capabilities now,
Huh.
staying ahead of the curve.
Seems to be the strategy, building that defensive moat for when standards inevitably shift.
Okay, that R&D investment nicely sets up the outlook.
Mm.
Despite the integration costs from Cryptas dragging on Q2 profits a bit, management sounded quite positive about the rest of the year, didn't they?
Very confident, actually. They stuck firmly to their full-year revenue guidance. That's INR 6,750 million to 7,000 million rupees for FY26.
So they expect a much stronger second half, H2. What gives them that confidence?
Well, a couple things mainly. First, they pointed to a pipeline of major product deals, particularly in the US and the Middle East. These are apparently multi-million-dollar contracts they expect to close in Q3 and Q4.
Landing the big fish.
Hopefully. Second, there's a bit of seasonality. Revenue linked to tax filing season, which uses their trust services, apparently got pushed from Q2 into Q3 this year. So Q3 should get a nice bump from that timing shift.
And the growth is expected to come mainly from...
Products. Definitely products. They stress that overall growth relies heavily on strong expansion in their product business. They cited 20-30% growth in the lead pipeline there. That needs to offset the stagnation we talked about in the U.S. services segment.
Makes sense. What about the bottom line? Can they hit their profit target with Cryptas still integrating?
They think so. The full-year PAT margin guidance remains 15.5% to 16%. The bet is that the core business strength, combined with revenue acceleration and hopefully Cryptas turning profitable in H2, will be enough to absorb those initial integration losses and still land within that target range.
It's a confident projection. Finally, let's just quickly touch on cash. These been a fair bit recently.
They did. About 950 million rupees went out for the two acquisitions, Cryptas and AI Cyberforge. Plus another 300 million on internal capex, mostly product development. That's 1.25 billion rupees deployed in H1.
So where does that leave their cash balance?
They ended the half year with 452.9 million rupees in cash and equivalents, which isn't huge after that spend, but the key message on the call was no more major acquisitions planned for the next 6 months.
Ah, okay. Turning off the acquisition spending tap for a while.
Right. So the expectation is that cash reserves should start building back up now as they focus on integrating what they've bought and generating revenue from it.
Okay, so wrapping it up, it feels like we've seen a company performing a bit of a tightrope walk, doesn't it?
Yeah, managing those upfront costs and integration headaches from strategic buys, dealing with external pressures like the H-1B visa situation.
While simultaneously trying to position their pretty comprehensive product suite to capture this big global push towards zero-trust security.
Exactly. It's about balancing execution risk with strategic ambition. But, thinking about their R&D, especially the heavy investment in generative AI, it brings up an interesting final point for you, the listener, to ponder.
Oh, what's that?
Well, they're pouring resources into AI for risk scoring, document intelligence, agentic commerce tech, aiming for automation and efficiency, presumably. Yet, a core part of their business, issuing digital signatures, especially in highly regulated markets like India, still relies on mandatory manual human verification steps. L1, L2 checks.
Right, regulations often require a human in the loop for identity validation.
Precisely. So this reliance on human intervention, driven by regulation worldwide, actually prevents full AI automation of the identity issuance process right now.
Huh. So the provocative thought is,
does this reliance on regulated human verification create a powerful moat for eMudhra? Does the regulation protect their business model from being totally disrupted by pure automation? Or does this dependence on mandatory human steps ultimately become a vulnerability? Does it cap the scalability and efficiency gains they could otherwise achieve from all that AI investment?
a moat or a vulnerability built on regulation. That's a fascinating tension at the heart of digital trust.
It really is something to think about.
Indeed. Well, that's our deep dive for today. Thank you for joining us as we unpacked eMudhra's strategy. We definitely encourage you to look more into those concepts like converged identity and the implications of post-quantum cryptography. We'll catch you on the next deep dive.